My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, not just to entertain, but to educate, to teach. Call me, 1-800-743-CNBC. Tweet Jim Cramer. The stock market, it's had an incredible run this year, yet two-thirds of Americans say they're not experiencing any benefits from it. How the heck is that possible? According to this Financial Times Peterson Foundation poll, only 14% of families own stocks outright, meaning the market's creating all this wealth for the few, not the many. 60% of Americans don't even know that stocks are up for the year, and they've advanced 24%. So after a sedate day where the Dow gained 28 points, S&P advanced 0.15%, NASDAQ climbed 0.05%. Let's talk about what the heck is going on here, and I think it's actually a lot more complicated than simple ignorance. The first reason why people who can afford to own stocks are sitting on the sidelines earning very little, the disastrous NASDAQ bear market at the turn of the century impoverished a whole generation of individual investors who got burned by chasing, yes, the hottest stocks imaginable. When the dot-com crash hit, it spelled the end of what we used to call the greatest story ever told, the public's love affair with stocks. I know. Hey, look, I was part of it. I started TheStreet.com in 1995, immediately found hundreds of thousands of people with a thirst for any investing knowledge to level the playing field between the rich and the not-so-rich. At the top, we had valuations, though, that were through the roof, with unsustainable and even fraudulent companies being pumped out by the hundreds by investment banks. It was a travesty. No one protected the public, and many individuals lost so much money that they swore they'd never come back. But half a dozen years later, investors started wading back in. And that's when they got hit with the financial crisis. And once again, people lost gigantic sums of money as huge institutions simply vanished. I think the 1-2 punch of the dot-com crash and the financial crisis alienated millions of potential shareholders. Oh, and the flash crashes of 2010 and 2015 sure didn't help. And that's when hundreds of billions of dollars were lost in minutes because the machines that control the market went haywire. People feel like the whole asset class is rigged against them. Like, you just don't have a level playing field between the fast-trading hedge funds and the hapless, poor individual investors. The second indignity, individual investors lost all their champions, both on Wall Street and Washington. It wasn't always like that. 20 years ago, I used to tag team with Dick Grasso. He's the former CEO of the New York Stock Exchange. We'd speak to throngs of people about the greatness of owning a piece of a company. Throughout his long tenure at the exchange, Dick was a tireless promoter of long-term investing in individual great American companies. His main goal, he wanted people to make money over the long haul by owning the stocks of companies they like. We used to call it owning a piece of America, and we loved it. Back then, there was a real sense that a rising tide lifts all boats. We didn't hear tons of stories about CEOs making billions while the workers get nickel and dime. Still, the important thing is that individual investors did used to have a champion at the top. Then Grasso subsequently retired in 2003 after some public outcry about his pay package. I got to tell you, he was worth it. But the next thing you know, a true champion of the little guy had departed from the scene. And since then, no one has taken up Dick Grasso's mantle. Maybe it was a business decision to avoid linking institutions to a weakened, disgraced asset class that they wanted to run from. Maybe it was the headlong rush into index funds that made it so owning a piece of America became a relic, a thing of the past. Maybe it's the joke of having hundreds of ETFs that lose people money, buying the latest and greatest through faux diversification, or those miserable double and triple juiced ETFs that separate fools from their money on a daily basis. Yep, we used to have leaders who championed owning individual companies. Now we have nobody, or at least nobody with any power. When you throw in all the scandals, all the chicanery, and the complete lack of punishment for the executives who really brought down this economy and this country during the Great Recession, it's easy for bearish commentators to grab the microphone. It doesn't matter if they've been consistently wrong about the stock market. This is a cynical era, people, where saying anything negative makes you sound smart. If you say something smart and something goes down and they play it on YouTube, you look like an idiot. These permanent bears, they have a real outsized voice. And something we know thanks to Michael Sembalist. He's the chairman of market and investment strategy at J.P. Morgan. He's been doing some incredible high-quality work on what he calls the armageddonists. These are commentators and money managers who do an amazing job of scaring you out of stocks into bonds, usually at the worst possible moment. They give no credit to the CEOs who build and manage incredible companies like an Apple or Microsoft, Amazon. For them, it's all doom and gloom. They're all famous. When I saw the names, the armageddonists, I know every one of them. The media is not much better. Sembla's latest piece has a remarkable bar graph titled, "The Medium is the Message, Relative Reporting of Positive Economic News on Select Cable Programs," end quote. And it turns out there's almost no reporting whatsoever about positive economic news. My jaw dropped when I saw that it was last on the list of stories that these cable networks covered. I wish I could share it with you. It's a JP Morgan piece of research. It's stunning. Now, of course, I should have known bad news gets better ratings than good news. I only get contacted by the national broadcasters, and they want someone to talk about how terrible things are and why you should panic. It's painful. It's wrong. You think the world's ending, but actually things are pretty good. So I can't really blame people for failing to recognize how much money is being made in the stock market, especially in the best-performing individual stocks, many of which we feature all the time here, including tonight, 3 of them. But that's why I felt so fantastic after last night's interview with those 2 gents from Robinhood. They're at the vanguard of a rekindled interest in individual stocks. They're leveling the playing field. They're democratizing the process of owning pieces of companies. And the message is resonating with who? Yes, millennials. They've already got 10 million accounts, up from 1 million a few years ago, which puts them in the same league as the major discount brokers, albeit, of course, we know that it's less money. But, man, they're just starting. And they're starting by owning stocks. I love this trend. I know that big money can be made owning stocks. I see it and hear about it every day. I have all my life. These new investors are doing so well. They believe in buying what they know and putting the stocks away. They own index funds, but they know that individual stocks can coexist with an index portfolio. They'll do well owning a piece of America, a piece of progress. You know what's best? These 10 million investors, they're willing to overlook the constant barrage of negative short-term news to do some long-term thinking and investing. And they're doing it at a relatively young age when they can afford to make back their losses if indeed something goes wrong, and it does. The bottom line, don't let the armageddonists and the negativists and the hucksters scare you away from owning stocks. There are vast sums of money to be made here, and far too many people are missing out because they've been frightened away from the whole asset class. Do not sit on the sidelines. It's time to get on the field. It's time to get a piece of a great American company and let that CEO work for you. Cindy in Georgia, please. Cindy.
Hi, Jim.
Cindy, what's up?
First of all, I want to tell you that I love the show HQ, and I wanted to ask you about something I spoke with you about a month ago, which is, do you feel positive about the future of Sage Therapeutics after the miss in the clinical trial results this morning? I
had such high hopes, Cindy. Major depression is just such a terrible thing, and it looks like that Sage and I was. It was just a sad thing. It looks like it's not working. A lot of us really felt that this was going to be the big breakthrough. We knew that they had great work on postpartum. Dr. Jeffrey Jonas had been on the show. It did not pan out. I would not sell at these prices, but it was a major blow. It really was. Let's go to Kevin in Florida. Kevin.
Hey, Jim, from Naples, Florida, and a happy Action Alert member.
Oh, excellent. Thank you.
Thank you. In May, along with the club, I bought Shopify for $250 and got out at $360, like you said, in August.
Right.
This past Monday, the network had an analyst on who talked about Thanksgiving Day weekend sales and how Shopify was up 25% same period. I am looking to get back in.
I know. And look, I was doing this thing. I do this thing, stocks versus stats for this bull market fantasy show that I do. And Catherine Ross, who works with me, she was saying, okay, listen, who's going to have more yards, so-and-so or Shopify, because Shopify at 360. And I had to say, listen, Shopify's probably not done. We made money for club members. I should have got back in. I felt that there was going to be a revulsion of the high multiples, the Zoom videos, and the Oktas, the companies I really like, PagerDuty. And it turns out that there is a revulsion right now. So I think stay away from Shopify. Stay away. It's better than some of the ones I just mentioned. Turns out it's doing, but it's gotten too high. Jay in Colorado. Jay.
Dr. Cramer. Booyah.
Booyah,
hey, man,
Doc.
I've been following you for
Doc.
15 years, TV, books, everything. I owe everything to you. and I can't thank you enough for all the things you've taught me over the years. I owe my entire style to you. So,
will you please call my wife? She's mad at me because I don't want to take the dogs out tonight. You can make this thing right with her.
I don't blame you, Cramer. Seriously. Hey, so BYND, Beyond. So I'm following this, obviously. I've been averaging down. Right now, that thing is down 50% over the last 90 days.
Yes.
It gets even better. The 1 month RSI, relative strength has now just dipped below that 30. So it's kind of like indicating an oversold. But then to boot, you got Costco, who just announced that they're going to be keeping, Beyond Burger.
I thought that was a very significant move by Costco because they are very concerned and care and quality conscious. I've done some business with them. All they ever care about is quality. And I felt that Ethan Brown is doing something really great here, Beyond. Here's my approach to Beyond. You've got to think about it in a 2, 3, 4, 5-year perspective because it's going to be too crazy. But they have a long-term view. And I think that vegans, vegetarians, and non-vegetarians all like it. I'm not recommending the stock, but I do think that you can own it for the long term. All right, guys, when we get these tips, you got to get off the sidelines. Don't put it all at once. That's not the way I think, but there is money to be made, lots of it. On Mad Money tonight, I found a winner in the tariff mitigation business, and it may surprise you. I'll reveal the name just ahead. Then it's one of the best performing stocks of 2019, but can Chipotle continue to kick it going into the new year? I mean, I gotta tell you, it's burritos something. I sat down with the company's top executives at one of its New York City locations. It looked so good. I wanted a burrito breakfast bowl. They don't have. And shares of ServiceNow jumped 14% in November. So what's now? I'm talking with the brand new CEO and old friend of the show, Bill McDermott from SAP, to find out what's in store. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.